Hello guys, welcome back again to my YouTube channel. In today's video we're going to be talking about POI. Simply means point of interest. So what you're going to be learning from this video is what is POI, how to identify POI, what are the benefits of using POI, and how to trade using POI. POI is a popular technical analysis tool used in the forex market. It refers to price levels or areas in the chart that traders identify as significant for potential trading opportunities. These points are often where prices are expected to reverse or react, continuing or exhibiting increase in volatility. Example of POI, we have the support and resistance, supply and demand, Fibonacci levels, psychological levels, trend lines, candlestick patterns. When identifying POI, you need to look for confluence in order to increase the probability of a successful trade. So, how do you identify POI? POI is usually identified through the use of Fibonacci tools such as moving average, Fibonacci retracement, trend lines, chart patterns, order block, candlestick patterns, and many more. Once a POI level is identified, traders can use to make an informed trading decision. So now let's go to the chart to actually know how to identify POI using the above mentioned. All right. So now we're going to be using our technical tool. Okay. Let's say the market is actually pushing to the downside, and then you have this, okay, you have this, all right, you have a sweep of liquidity, and then you have a break of structure to the upside. So what this simply represents is that we have what the whole of this is what our swing what structure. Okay, the whole of this is our swing structure. So we have, what do we have here? We have what? A sweep of what? Liquidity. So since we have a sweep of liquidity, this becomes what? Our protected what? Low. And this becomes what? Our protected what? High. So how do you identify where the POI comes in? Okay, how do you identify where the POI comes in? So this becomes your protected high and your protected low. So therefore, from your swing low to the swing high, this becomes what? Our swing what? Structure. So now, where do we identify or spot to actually be our POI? All right, that's a tough question. So we have our Fibonacci tool, here being the premium and here being the discount. Okay, so then again, you take it from there. After identify your swing structure, you take it from here where the break of structure happened. Okay, where you have your first break of structure. So now, where is the discount level? We have the premium, we have the discount. So are you going to be buying from here? Are you going to buy from here? Are you going to buy from here up? No, that's not a good idea. So it's better you wait for price to actually come to the discount here. So below here, anything below here, you can actually buy and it's safe. So that is what becomes your point of interest. Okay, using your Fibonacci tool, you're able to identify your point of what interest. Okay, so this is what our point of interest. So basically, how do you mark out the point of interest? We'll look at that when we go to the chart. Okay, so we've been able to mark our area of our point of what? Interest. So then we have a break of structure. This is our first break of structure, guys. That's our first break of structure. All right, so we have the swing structure. So what do you want? For this POI, for a POI to be valid, there must be what? A structural what? Liquidity. So what happens? The market comes down to here and then gives us what? Another break of structure. What happens? What do we call this? This is what? This becomes what? Our what? Our structural liquidity. Okay, that means the market has to come take the liquidity that's resting below this area before we can actually what? Take a trade. The market needs to come take the liquidity that's resting below this area, then tap into our POI, then we take our trade. And then this second break of structure is referred to as what? Our what? Transactional liquidity. Okay, so the market needs to come back all the way right to here, and then here should always be your target. Market needs to tap into your POI before you can actually take a trade. So now let's look at, let me just delete this and just try to like make it clearer. Okay, so let's look at an example right here. Okay, all right, so how do you identify a POI? So to identify a POI, all right, you use order blocks to mark out your POI after narrowing it down using your Fibonacci tool. Use order block. So for the bearish order block, okay, is for the bearish order block, to identify a bearish order block, you use the last bullish candle, okay, the last bullish candle before the market actually pushed to the downside. Okay, the last bullish candle before the market actually will push to the downside. So if this is your last bullish candle, then the bearish candle came in. Okay, so if this is your last bullish candle, all right, so this what becomes what? Your order block. Okay, this candle right here becomes what? Your order block, the whole of this candle. So that becomes what? Our order block. All right, so the last bullish candle before that impulsive move to the downside. Okay, before the impulsive move to the downside gives us the order block. So to identify that, okay, what happens? Market comes, sweeps that area, give us a break of structure to the downside. Okay, right, then gives us a pullback to validate what? The POI, and then gives us another break of structure to the downside. So what happens? There is what? A sweep of liquidity here, which you can clearly see. We have a what? A sweep of liquidity. So now what happened? This order block is now a failed order block, but although it's still valid because we are using it to mark out our POI, where the market is likely expected to what? React, okay, from. Market is likely expected to react from that area. We have our sweep of liquidity. Then the market we now have a break of structure right here. That's our first break of structure. All right. We have our first break of structure. And then we have a pullback. This pullback gives us what? Our what? Structural liquidity. That the market will come, sweep the structural liquidity, tap into our POI, and then gives us. If this is our swing structure, all right, this becomes the whole of this right here. Remember, I told you guys is what? known as our swing structure. So since we have the swing structure ready, then therefore this becomes what our protected high, and then this becomes our protected low. All right, so we have our first break of structure, a pullback to provide structural liquidity that will be what swept later, and then what happened, we have our second break of structure, right? We have our second break of what structure. So what do you do then? Wait for the market to pull back right into your PY, and then what happened? You sell all the way here. All right, wait for the market to actually push back right all the way to our PY, then you sell all the way to your target. So now let's look at something here. Like I said, this is what let's say the market is actually pushing to the downside. This is okay. We have our sweep of liquidity. Okay, so you pick your fib from here to here. So the premium at the 50%, okay, it's our premium. That's where you mark your PY. All right, so you just have to take note of that. So now let's look at some examples. All right, so right here you can actually see the GBP USD chart. All right, so and this market is what in an uptrend. So right here you can actually identify the trend of this market, that the market is what in an uptrend. And even if you check the weekly, right? So let's say I identify a short-term opportunity right here. So what do I want to do? If I identify a short-term opportunity, what do I want to do? I want to actually scalp this market. All right, so as you can clearly see here, let me just show you guys something. I know the trend of the market is to the upside, yeah, but you can still scalp your substructure, okay? Substructure, you can actually still scalp it. All right, so right here, if you can clearly see, you just have to train your eyes very well. We have what? A sweep of what? Liquidity, all right? We have our sweep of what? Liquidity, all right, guys? So you can clearly see that. We have our sweep of liquidity. All right, we have our sweep of liquidity right here. All right, what happens then? We have our break of structure. And then we have our pullback, which provides what? Our structural liquidity. All right, we have our pullback right there. So what happens then? This becomes our protected high, all right? Because we already have a second break of structure right here. We have our first break of structure right here, right before the pullback to provide what? Structural liquidity, all right? And then we have our protected what? Low, okay? So, and then this becomes what? Our what? Protected high, okay? So if you go to the smaller time frame, like the 30 minutes, which we're going to do right now, you'll be able to spot out your POI, be able to mark it out, right? Be able to mark it out. So right here, we have our last bullish candle before that sweep. Okay, we have our last bullish candle before that sweep. All right. So you guys can clearly see it there. So, but in this particular case, it has already been tested. Okay, after the break, the market came, tested it before pushing to the downside. Yeah. So in that case, you can actually redefine it. Okay, but that notwithstanding, it still what served its purpose. Okay, see how the market came, tapped into it, gave us a confirmation candle on the 30 minutes time frame. Okay, that means you can actually sell right here. Okay, the stop loss just slightly above that candle. All right, if you want to trade with the confirmation candle, or you could, if you want to actually trade the aggressive, is actually to set the sell limit there. Okay, aggressive entry. All right, set the sell limit there, and then your stop loss just right above, and then your target here. Okay, simple 50 pips. All right, but if you want the less aggressive, you use the confirmation entry using the candlestick pattern. Your stop loss just slightly above. All right, and then your target still the same 50 pips, but the stop loss, the stop loss is it's more safer, right? So you have your stop loss just right there, and then smash at the target. All right, but if you wish to actually hold, you can actually still hold, let some positions run always, guys. You can always allow some positions to run. Already know that the market is an uptrend, so you don't want to hold for too long. Okay, why? Because the market is an uptrend. You're trading with the higher time frame. All right, so another reason why I think you need to, okay, we have looked at how to actually identify a PY. All right, let's look at one more example. Okay, so right here, I just want to bring my Euro GBP chart, okay, guys, so that you guys can actually, we can go through it together. Okay, so this is the Euro GBP. All right, so as you guys can clearly see right here, all right, we're just going to mark it out together. Okay, I think I should use the 4 hours time frame for this. Okay, but the market did not actually come back. Well, the thing is, do you identify these? Okay, it's the major important thing here. That's what is really important to us. So right here we have what, a sweep of what, liquidity. All right, so we have our sweep of liquidity. We have a break of what, structure. Sorry, we have our break of structure, which you guys can clearly see. We have our break of structure right here. All right, so right here we have our sweep of liquidity. And then we have our break of structure right here. And then we have our pullback. You pick your Fibonacci tool. That's your swing structure. You first identify the swing structure. So yeah, that's our swing structure, which is then you move it from here to here. That's where the break happened, the initial break happened. So now where becomes your PY? Right here. Okay, because you cannot take your cells anywhere. You cannot take your cells right here. You cannot take your cells here. It will not make sense. Why? Because the stop loss will be too massive. So, and you cannot put it here. You cannot put it anyhow. So you mark out your PY. Your PY should be right here. So the thing is, I'm just going to go down now to the smaller time frame. All right, and we have our last bullish candle here before the sweep inside this area. Okay, inside of this area, you can see that last bullish candle. So that becomes our PY. So, but in this particular case, the market did not come back. If the market did, would have just taken that trade, and you see, but we did not take it. The market went further to actually hit our take profit target. All right, but let's go down to the 1 hour time frame and look at things. Okay. All right, so I think I'll still leave it to this, because if I want to mark from here to here, that means the market has already tested it already. So I'll leave it at this, because that was a bullish candle already before the sweep, because that was a current one, all right, before that sweep happened. So, but the market did not actually come back to it. All right, but here again, you can clearly see that this market is already in the downtrend. All right, so what do you do from here? You can actually identify. It's still not playing out yet though, but I think tomorrow, today is Monday, so the market volume is actually low. We have what? Our sweep of liquidity right here. Okay, we have our sweep of liquidity, and then we have our break of structure right here. All right. So since we have our break of structure, this becomes what? The whole of this becomes what? Our swing structure. Okay. So if this is our swing structure, if the whole of this becomes our swing structure, then that means this becomes our what? Our protected what? High. Okay. All right. So and then we have our second break of what? Structure right here after the pullback. So we have a pullback which is up to 50%, which is even more than 50%. That provides what? Our structural what? Liquidity. So now it comes to the matter of marking out our POI. Where is the POI? This last candle right here. Okay, this last bullish candle before this bearish move. This last bullish candle before this bearish move, and then the market came back and swept it. That's at the order block. That is the POI. You mark it out. So right here, you can clearly see how the market came back. You tapped into it, okay, but it's still playing around, but certainly and surely it's going to what? Sell. So based on confirmation, you enter. You can decide to target here, but I think this marker is still going further down. So you get your 1:3, right? Sharp, but this can be your first target, okay, and then subsequent target, just like that. So that's that. Let's look at another example. Euro USD. Let's look at another example. Euro USD. All right. So for Euro USD, what am I looking at? What am I expecting for the coming days? All right. First, let's go to the 4 hours. All right, but I know the market is actually coming down to here, okay, because I have a POI right here. But then again, let's look at the current market structure, okay. Why I said you can actually trade the substructure, okay, to where you actually want it to go, the market to go. Right here, you can see that we have what? A sweep of what? Liquidity. All right, we have a sweep of what? Liquidity right here. But I think I should go down to 30 minutes time frame so that I can get more clarity. All right. So right here, you can see that the market pushed to the downside, pushed up, and then we have a sweep right here. Okay. We have our sweep. Although it's not that clear, yeah, it's not. I think I'll leave this. It's not clear. Now let's focus on the 4 hours time frame. Yeah. Let's focus on what we have on the 4 hours. Okay. So on the 4 hours here, you can see that the market actually pushed to the upside, but made a low push to the upside. And then what happened? We finally have what? A sweep right here. We have what? A sweep, okay? Sweep of liquidity right here. And then we have our first break of structure, which is right here. Okay? So we have our first break of structure, which is right there, which you can clearly see. We have our sweep, we have our first break of structure. So that becomes what? The whole of this right here now becomes what? Our swing structure. Okay. So if the whole of this right here before the pullback happen is our swing structure, what happens? This becomes the protected low. Okay. And then now the market pulled back to give us what? Our structural what? Liquidity. All right, this is our structural liquidity. So right here, you pick your Fibonacci tool from the low to where your first break happened. Now, where can you actually mark to be your POI? So our POI becomes this area right here. Okay, our POI becomes this area right here. So, but we can go down to the smaller time frame and redefine the whole thing. Okay, so and then we have our what? And second break of structure, which is what? Our transactional liquidity. All right, our transactional liquidity. Yeah, I hope you guys are taking notes. This becomes what? Our transactional what? Liquidity. This is what our structural liquidity. And what is the structural liquidity meant for? It's meant to be what? Taken out. Okay, these are structural liquidity, and that's the transactional liquidity. Okay, so right here, you're waiting for the market now to come and grab the liquidity resting below this area before pushing to the upside. Now let's go down to the 1 hour time frame and redefine what this setup, okay, this POI for the charts to load. So you can clearly see right here, okay, this is the last bearish candle, okay, before the market actually swept this area. Okay, we have this. So ordinarily this is supposed to hold, okay, but it did not. So this is our POI right here. Okay, so what happened? We wait for the market to actually come back, grab the liquidity, and then we can just go for a 1:3, 1:4, just whichever you just want to take, okay, and just go for it. So this is what I'm looking at on Euro USD. So now, what are the benefits of using POI? It helps traders to avoid making emotional trading decisions. By that, I mean it helps traders to identify key levels where the market can reverse or bounce back, and then traders can actually set their stop losses on and then their take profit according to what the parameters they see. So like without relating to the chart here now, we have actually identified our POI, and then we can actually use the aggressive method of entering of you setting what your pending order right here, your stop loss, and then your target. So what happens when the market comes here? Automatically it triggers you in. So POI helps you what? To be patient and not jumping from one trade to another. Okay. And secondly, it helps us to minimize our losses and maximize profit. And then it also helps us to stay disciplined and focus on the trading strategy rather than jumping from one trade to another. It can also be used with other technical tools such as the supply and demand zone, the Fibonacci retracement, order blocks, volume profile to provide what confluence, which can help us to improve what accuracy. So for me, basically, looking at this chart, I trade using what the confirmation entry. So what happens is when the market comes to this area, I wait for candlestick confirmation like the pin bar, the hammer in this particular level. So when I get that, that's the time when I would take the trade. So now let me show you guys an example of not using confirmation entries. So let's go back to GBP USD chart. Let's go back in time. Okay. So right here, you can see that this market, we have a sweep of liquidity and then came back, tapped in, and then what? You know that, okay, this market is actually going higher. All right. So, but it created a high, came back. We have a sweep of liquidity right here. Okay. We have a sweep of liquidity right here. Right. So what does that now leave us? We have a sweep of liquidity. We have what our first break of structure right here. We have our first break of structure. And then to identify your POI, then we have our second break of structure because this is actually valid, okay? We have our second break of structure. And that second break of structure is referred to as what? The transactional liquidity. So we have our structural liquidity right here. So then this becomes what? Our protected low. So why you actually need confirmation entries, all right? So now let's say you have actually marked out your POI, because from the swing low to here, where the first break happened, all right? So what happens? We have right here this bearish candle, which was the last bearish candle before that impulsive move, and then the market came back and swept it. So imagine now that you have, that's the POI, this bearish candle right here. See this bearish candle, these are order block, okay, the failed order block. This is the last bearish candle before the market actually pushed to the upside, and then the market came back and then swept it, okay? So now we just go ahead and delete our fib. Okay, this is our structural liquidity. Always remember that. So this trade is actually valid because of what the structural liquidity. So market took this liquidity below that area. So let's imagine now that you just decided to put your pending order without the confirmation entry, and then your stop loss just below. What will happen? You'll be stopped out. But if you decide to use the confirmation entry, what happened? You have this candle here, this engulfing candle right here. So at the close of the engulfing candle, what happens? You take your trade, stop loss just below. See, you just smashed. Your 1:4 risk to reward. That's why you need confirmation, okay? It stops you from unnecessary losses. Guys, please, if you like this video, just hit the like button, subscribe to this YouTube channel. See you guys in my next video.